Welcome back to the deep dive. Today we're going deep into dividend stocks and how they could impact your retirement.
Sounds good.
Our source is Nut Stuff, and their two-part article, 20 dividend stocks that could blow up your retirement.
Oh, wow.
Yeah. So before we get started, though, a quick disclaimer. While Nut Stuff tries to be accurate, they're not giving financial advice here. So always do your own research, folks.
Always a good reminder.
Absolutely. Now, to help us break down these stocks, we have with us Madison, a financial expert from Nut Stuff.
Hi, everyone. I'm Madison, and I'm happy to be here with Max to kind of go over all these stocks.
Great to have you, Madison. So, high-yield dividend stocks sound really amazing, especially when treasury yields are so low. But Nut Stuff calls them a siren song.
Yeah.
And that makes me a little nervous.
Yeah, it's a really good analogy. High yields can be tempting, but they can also mask some instability.
Yeah.
A company might offer a big dividend, but actually be earning less than they're paying out.
Right.
And that's not sustainable. Eventually they might cut the dividend or the stock price could just plummet, and that would really hurt your retirement portfolio.
So it's about more than just chasing those big numbers, right?
Jay.
We need to understand the companies behind them.
Exactly.
So Nut Stuff has grouped these 20 stocks by sectors, which I think is really helpful. Let's start with real estate because it seems to be a major player here. What do you think?
Yeah, and within real estate, REITs are really prominent. So real estate investment trusts. And these companies own income-producing properties like offices, apartments, even cell towers, and they must distribute a large chunk of their profits as dividends.
So that's why they're so popular with income-focused investors.
Exactly.
Makes sense. Nut Stuff mentioned several REITs, including Healthcare Trust of America, focusing on medical buildings, Boston Properties and Cousins Properties and high-end offices, UDR and Camden Property Trust, specializing in apartments, and Realty Income, which stands out with its monthly dividends. Wow, monthly dividends, that's pretty incredible.
Yeah, Realty Income has really built their brand around those monthly payouts and has a great track record of increasing them over time. So that consistency can be very appealing, especially for someone relying on that income.
Yeah, I bet. It's fascinating how even within real estate, the strategies vary so much. Another one that caught my eye was Alexandria Real Estate Equities.
Oh, yeah.
What's their angle?
So what's fascinating about Alexandria is that they're really deeply embedded in the life science sector. So they don't just lease out space. They have a venture capital arm that actually invests in life science startups.
Wow.
So this means they're not just betting on real estate, but on the success of the companies they house.
So their dividend success is tied to the growth of these cutting-edge companies. It's like a double bet on innovation.
Okay, let's shift gears a little bit to energy, another sector heavily featured on this list, and it's obviously going through a lot of change right now. Absolutely. We see this with BP, right? A classic oil giant that's trying to pivot towards renewables. And they face some setbacks, like the Deepwater Horizon oil spill, exiting Russian assets. And investors are really watching to see if they can truly balance oil and gas with their renewable ambitions.
It sounds like they're trying to navigate a really tricky transition. Nut Stuff also highlights the EnLink midstream acquisition by Weneo.
Yes.
Does that signal any bigger trends in energy?
Yeah. The EnLink midstream acquisition by Weneo is a prime example of the consolidation happening in the energy sector. So as the world seeks to diversify energy sources, we're seeing companies merging to strengthen their positions and adapt to this shifting landscape.
Survival of the fittest in a way.
Yeah, in a way, for sure.
Now, what about HF Sinclair? How are they approaching this energy shift?
So HF Sinclair presents a really interesting case because they're trying to diversify by including renewable diesel in their portfolio alongside traditional fuels. And this strategy shows they're trying to adapt, but it also raises the question of whether their dividend can remain stable if traditional fuels start to decline.
That's a really good point. The sustainability of these dividends really relies on how well these companies adapt. Okay, let's move on to infrastructure, another sector that Nut Stuff flagged. What do we got here?
Right. They highlight Brookfield Infrastructure Partners, which is a global player with a really vast array of assets. We're talking power lines, pipelines, transportation, even data centers. So they're involved in all the essential services that keep the world running.
Their description as boring but reliable, I think it really caught my eye.
Yeah.
Does that translate to steady dividends?
That's the idea. Because they provide services that people need regardless of the economy, right? Their income is relatively stable. And that makes them really appealing to income investors who prioritize that consistency over high growth.
So they're the slow and steady tortoises in the race, while others are more like hares, potentially faster, but also much riskier. What other sectors are on Nutstuff's list of potential dividend pitfalls?
So they highlight a few more telecom healthcare and then a diverse mix of companies that are a bit harder to categorize.
Okay,
Should we dive into those?
absolutely. We've just started uncovering the nuances of these dividend stocks, and I'm already intrigued. Let's continue this deep dive.
Disclaimer. North Breach Limited, Nutstuff trading name, is an appointed representative of Messels Limited, which is authorized and regulated by the Financial Conduct Authority. Nutstuff has made every reasonable effort to ensure the information provided in this communication is correct. But Nutstuff makes no representation nor any warranty as to whether the information is accurate, complete, or up to date. To the extent permitted by law, Nutstuff accepts no responsibility for any errors or misstatements, negligent or otherwise. Nutstuff, its associates, officers, or employees may also have interests in the financial instruments referred to in this information by acting in various roles. The information in this media is confidential. If you are not the intended recipient, you are not authorized to use the information in this media in any way. Nutstuff does not guarantee the integrity of any media or attached files. The view or opinions expressed are the author's own and may not reflect the view or opinions of Nutstuff. Electronic communications carried within the Nutstuff system may be monitored.
Welcome back to the deep dive. We're continuing our exploration of Nutstuff's list of 20 dividend stocks that could impact your retirement.
Yeah, so far we've seen how important it is to look beyond those tempting high yields and really understand what's driving them.
That's right. A high yield can be a sign of strength, but it can also signal some underlying problems that could put your retirement savings at risk.
Definitely something to keep in mind. Let's dive back into the specific companies Nutstuff highlighted, starting with Healthcare Trust of America, or HTA. What makes them stand out?
So HTA's strategy is interesting because they're laser focused on one specific type of real estate, medical office buildings.
Okay.
And these buildings are typically located near hospitals and medical centers, places with consistent demand for healthcare services.
Makes sense. Healthcare is a growing sector, especially with an aging population. Does that translate to stable dividends for HTA investors?
Well, their focus on these specialized properties does tend to insulate them from some of the volatility we see in other areas of real estate. Plus, their tenants are often healthcare providers with long-term leases, which contributes to a steady stream of income.
So it's not just about the sector, but the specific niche within that sector.
Okay, let's move on to the next company. Smurfit Westrock Packaging doesn't sound particularly exciting,
Yeah.
but I'm sure there's more to it.
Right. What's interesting about Smurfit Westrock is how they've positioned themselves within the packaging industry. They've become a global leader in sustainable packaging. Using renewable and recycled materials, that's a smart move considering the growing consumer demand for eco-friendly products. But does that focus on sustainability translate into financial stability and reliable dividends?
You know, sustainability is becoming increasingly important for investors. It's not just about doing good, it's about mitigating risks and finding companies that are well-positioned for the future. So Smurfit Westrock's emphasis on sustainability helps them attract environmentally conscious customers and investors, which can be good for their bottom line and their dividend payouts.
It's a reminder that dividends aren't just about financial numbers. They're also about the company's values and long-term vision. Okay, let's revisit Realty Income, the company that prides itself on those monthly dividend payments.
Yeah, Realty Income is a favorite among income-seeking investors. What's impressive about them is their incredible track record. They've increased their dividend for over 25 consecutive years,
Wow.
which is a testament to their disciplined approach and their ability to weather economic storms.
That kind of consistency is definitely attractive for someone relying on that income in retirement. What's the secret to their success? Is it just their focus on retail properties?
Well, while they do have a large portfolio of retail properties, their success is also driven by diversification. They have tenants in various industries, including grocery stores, drugstores, convenience stores, and even movie theaters.
Interesting.
This spread helps them reduce risk and maintain stable income even if one sector faces headwinds.
So it's a combination of careful tenant selection and smart diversification. Now let's circle back to Alexandria Real Estate Equities, the company we discussed earlier that's tied to the life sciences sector.
Right. Alexandria is a unique case because they're not just a traditional REIT. They're actively involved in supporting the growth of the companies they lease space to, particularly in the biotech and pharmaceutical industries.
Yeah, it sounds like they're betting on the future of these cutting-edge industries.
Yeah.
But is that a risky strategy when it comes to dividend stability?
It can be. The life sciences sector is known for its innovation, but also for its volatility. Drug development is expensive and uncertain, and companies can face setbacks. However, Alexandria mitigates some of that risk by focusing on established companies and by diversifying their portfolio across different subsectors within life sciences.
So they're balancing risk and reward by tapping into a high-growth sector while being selective about their investments. Okay, what about Camden Property Trust? What's their story?
So Camden Property Trust is focused on developing and managing apartment communities, primarily in the fast-growing Sunbelt region of the United States. Their strategy is to provide high-quality living spaces in desirable locations with strong job markets.
That makes sense. As populations shift and certain regions experience economic booms, focusing on those high-growth areas seems like a solid strategy.
Yeah, and that success also hinges on understanding the needs and preferences of their target demographic. They cater to a more affluent renter base that prioritizes amenities, convenience, and a sense of community.
It sounds like they're tapping into broader societal trends such as the rise of remote work and the desire for more flexible living arrangements. Now let's switch gears and discuss American Tower, a company that plays a crucial role in our increasingly connected world.
Okay, American Tower is a REIT with a global presence specializing in communication infrastructure. They own and operate a vast portfolio of cell towers, antenna sites, and other assets that support wireless networks.
Yet with the explosive growth of mobile data and the rollout of 5G networks, I imagine American Tower is well positioned for future growth. But is that growth sustainable? And how does it translate into reliable dividends?
Well, their business model is tied to the increasing demand for wireless connectivity, which shows no signs of slowing down. As more people rely on mobile devices and as data-intensive applications become the norm, companies like American Tower are essential for providing the infrastructure to support it all.
So they're not just riding a trend, they're providing a critical service that underpins our modern way of life. Now let's talk about AbbVie, the pharmaceutical giant behind the blockbuster drug Humira.
Right. AbbVie has enjoyed tremendous success with Humira, but they're also aware that it's facing competition from biosimilars, which are essentially generic versions of biologic drugs.
Right, I've heard about biosimilars, but I'm not entirely sure how they work or how they impact a company like AbbVie.
So essentially, when a biologic drug's patent expires, other companies can develop and market biosimilar versions, and this competition can drive down prices and erode the original drug's market share, impacting the company's revenue and potentially its dividend.
So it's a constant race for innovation in the pharmaceutical industry. Companies like AbbVie need to keep developing new drugs to maintain their market share and their dividend payouts.
Absolutely. AbbVie is investing heavily in research and development to create the next generation of blockbuster drugs. Their future success and their ability to continue paying dividends depends on their ability to bring new therapies to market.
It's a reminder that even established companies with successful products can't afford to stand still. They need to adapt and innovate to stay ahead of the curve. Okay, let's move on to EnLink Midstream, a company that was acquired by OneOak earlier this year.
Right. The EnLink Midstream acquisition is a great example of the consolidation happening in the energy sector. OneOak, a major natural gas company, saw the strategic value of EnLink's assets and their presence in key shale basins.
So it's about expanding their reach and strengthening their position in the market. But what does that mean for investors who are holding EnLink stock? Did they benefit from this acquisition?
Well, typically in an acquisition, the acquiring company offers a premium to the current share price of the target company. So EnLink shareholders likely received a payout that was higher than the market value of their shares at the time.
It sounds like a win for those shareholders. But it also highlights the importance of understanding the dynamics of mergers and acquisitions when you're investing in dividend stocks.
Absolutely. A company's dividend policy can change after a merger or acquisition. So it's crucial to stay informed and assess how those changes might impact your investment strategy.
Now let's talk about HF Sinclair, the company that's trying to diversify its portfolio by including renewable diesel.
Yeah, HF Sinclair's strategy is interesting because they're trying to find a balance between traditional fuels and renewable alternatives. They're recognizing the need to adapt to the energy transition while also leveraging their existing infrastructure.
It sounds like they're hedging their bets, keeping a foot in both worlds. But is that a sustainable strategy in the long run?
It depends on how quickly the demand for renewable fuels grows and how government policies evolve. If the transition to clean energy accelerates, companies like HF Sinclair need to be prepared to shift their focus accordingly. Their ability to adapt will be key to maintaining their dividend payouts.
Okay, for our last company on Nut Stuff's list, let's revisit Trend Micro, the cybersecurity firm that's been making headlines due to rumors of a potential private equity buyout.
Okay, so Trend Micro has carved out a niche for itself in the cybersecurity market, but they're also facing increasing competition from larger players. A private equity buyout could provide them with the resources and expertise to scale up their operations and compete more effectively.
But a buyout could also bring changes to their management team, their strategic direction, and potentially their dividend policy.
Exactly. It's important to remember that private equity firms have their own investment goals and timelines. They might prioritize short-term profits over long-term dividend growth.
So it's a situation that requires careful monitoring for investors who are holding Trend Micro stock. Now, Madison, as we wrap up this part of our deep dive, I was struck by the sheer diversity of these 20 companies and the various factors that can impact their dividend payouts.
It's a reminder that dividend investing requires more than just looking at yield. It's about understanding the underlying businesses, their management teams, their competitive landscapes, and the broader economic forces that shape their destinies.
It sounds like successful dividend investing requires both a keen eye for detail and a broad understanding of the world around us.
Well said, Max. Now let's move on to the final part of our deep dive, where we'll synthesize what we've learned and offer some key takeaways for our listeners.
Welcome back to the deep dive. We've spent this episode really getting into Nut Stuff's list of 20 dividend stocks, and I have to say it's been eye-opening.
Yeah, we've covered a lot exploring companies from different sectors and really looking at what can impact those dividend payouts.
It's clear that dividend investing is a lot more complex than just chasing those yields.
Yeah.
So what are some of the key takeaways our listeners should keep in mind?
Well, one of the biggest is that a high dividend yield isn't always a sign of a healthy company.
Right.
Sometimes those big payouts can be a way to kind of mask underlying problems, like a company earning less than it's paying out in dividends.
That can't be good.
Yeah, that's not sustainable long term.
So we need to be skeptical and really look under the hood of these companies we're considering.
Exactly. Look beyond just that yield and really assess their financial health, their competitive position. How are they going to grow long term? A company with a solid business model and a history of responsible dividend policies is more likely to provide consistent income over time.
We've also seen how those big economic trends and industry shifts can impact dividend sustainability.
Right.
Like the energy sector is changing so much as the world moves toward renewable energy.
Yeah.
Companies need to adapt fast to stay competitive and
Absolutely.
maintain those dividends.
And even seemingly stable sectors like real estate can be affected by things like interest rates, changing consumer behavior, and even technology.
Yeah, that's why diversification is so important.
Exactly.
Spreading our investments across different sectors, different types of companies, even different regions
Right.
could really help to lower risk and create a more stable income stream for retirement.
Absolutely. Another crucial takeaway, I think, is that dividend investing is not passive. You have to do your research, stay informed, and monitor the companies you've invested in.
It's not just set it and forget it at all.
Yeah.
We need to be engaged and adaptable.
Yeah. And finally, remember that dividend investing is a long game.
Oh, yeah, for sure.
Don't get caught up in the day-to-day market swings or chasing the latest hot stock.
Right.
Focus on building a portfolio of high-quality companies with a good track record of dividend growth and the potential to continue paying those dividends well into the future.
Great reminder to stay focused on our goals and not get too swayed by, fear or greed.
Absolutely. Now, as we wrap up this deep dive, I want to leave our listeners with one final thought. As you're continuing your journey in dividend investing, think about this. How might things like inflation and interest rate changes affect dividend payouts and stock prices in the future?
Wow, that is a great question to think about. The financial markets are constantly changing. We need to be ready to adapt.
Absolutely. Continuous learning and a healthy dose of skepticism are really essential for navigating this complex world and building a secure financial future.
Well, Madison, thank you so much for sharing your expertise with us today. This has been a fantastic deep dive into dividend stocks.
It's been my pleasure, Max. I really hope our listeners found this exploration helpful and informative.
And to all our listeners, thank you for joining us on this deep dive. Remember, knowledge is power, especially when it comes to your financial future.
Until next time, happy investing, everyone.